there are things that you must be aware of. In the chapter agency law, there are things that you must be aware of.
Classification of investment projects. Classification of investment projects. Classification of investment projects. Number one, mutually exclusive investments. Mutually exclusive investments. See? These are alternative investments which serve the same purpose and compete with each other i.e. the projects cannot be undertaken together. The projects cannot be undertaken together. E.g., building a road and an air and a railway line. E.g., building a road and a railway line. Number two, mutually inclusive investments. Mutually inclusive investments these are investments or projects. These are investments or projects which will be undertaken together. Which will be undertaken together. Which will be taken together. I.e., they complement each other. I.e., they complement each other. E.g., building a bridge and a road. Building a bridge and a road. Independent projects. Independent projects. Independent projects, say. These are investments. These are investments that serve different purposes. That serve different purposes and do not compete with each other. Do not compete with each other. And they are therefore accepted. And they are therefore accepted depending on their viability. They are accepted depending on their viability.
communication. Seriously, communication, the agent should never disclose. The principal should obey when the agent handles the principal.
Right. Capital budgeting techniques. Capital budgeting techniques. See, these are techniques used to determine viability. These are techniques used to determine the viability of investments. Viability of investments. They determine whether an investment should be taken or not. They determine whether an investment should be taken or not. Should be taken or not. Qualities of a good investment evaluation criteria. Qualities of a good investment evaluation criteria. Qualities of a good investment evaluation criteria. Number one, it should maximize shareholders' wealth. It should maximize shareholders' wealth. Number two, it should apply cash flows and not profits. It should apply cash flows and not profits. It should apply cash flows and not profits. Number three, it should consider cash flows accruing over the entire life of the project. Cash flows accruing over the entire life of the project. Cash flows accruing over the entire life of the project. Next, it should help in ranking projects. It should help in ranking projects according to their profitability. According to their profitability. According to their profitability. Next, it should recognize the time value of money. It should recognize the time value of money. Time value of money. Same. Capital budgeting techniques. Capital budgeting techniques are classified as follows. Capital budgeting techniques are classified as follows. Number one, this non-discounted cash flow techniques. Non-discounted cash flow techniques. Non-discounted cash flow techniques. And that have a payback period. A payback period. B, accounting rate of return. Payback period and B, accounting rate of return. Number two, discounted cash flow techniques. Discounted cash flow techniques have a net present value. Net present value. 2, internal rate of return. 3, profitability index. 3, profitability index. Profitability index. 4, modified internal rate of return. Modified internal rate of return. Number 1. Non-discounted cash flow techniques. Non-discounted cash flow techniques. We say these are capital budgeting techniques. These are capital budgeting techniques that do not consider the time value of money. That do not consider the time value of money. And therefore, they do not discount cash flows. And therefore, they do not discount cash flows. They do not discount cash flows. They include, number 1, the payback period. Number one, payback period. You see, this is a discounting, is a capital budgeting technique. This is a capital budgeting technique that measures the number of years, that an investment will take for the investment to recover its initial investment amount. For the investment to recover its initial investment amount. Its initial investment amount. Its initial investment amount. The payback period is computed as follows. Initial investment divided by your annual cash flows. Annual cash flows. Initial investment divided by annual cash flows. Have an example. A project costs project costs 18 million shillings. 18 million shillings with annual cash flows of 5 million. Annual cash flows of 5 million. Calculate the project's payback period. 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 Now, basically, payback period here simply a technique of capital budgeting or evaluating projects that an organization will want to take by considering the number of years the investment will return its initial outlay, or the amount that was invested, how many years will that amount be recouped? For example, if you invested 1 million shillings, how many years will you generate, or will you recover your 1 million shillings if your cash flows, or if the project gives you 200,000? So you take 1 million divided by what? 200,000. So you say it's 5 years. So in this case, the investment is worth how much? 18 million. That is what it is worth. And each year, it is generating cash flows of how much? 5 million. So how much is that?
3.6.
The remuneration and the benefits of the charges, the total results.
3.6 years. Hapo sawa?
Yeah.
Have a second example. Have a second example.
Shall not divide all the
A company invested in the following projects. The following projects that generated the following cash flows. That generated the following cash flows.
involvement of the independence of the teacher. Why is it that the teachers to protect the rights of the people of the yes, it ensures effective administration of staff. It acts as a guardian of the Constitution. It protects the individuals from the moderation. The other issue about the law of administrative law, you must know what is judicial review, and again judicial review.
Say, calculate the project's payback period. Calculate the project's payback. Right. So how many years will the project take to recover its location? So what you do, in this case, notice the cash flows are very different. Year one, you're generating a cash flow of 600, 18, 32, 35, 219. So you want to know the amount you invested, which is this 8 million shillings or 8,000 shillings. How many years will you take to do what? To recover that amount. So what you do, you come here and first accumulate. Determine your cumulative cash flows. Your cumulative what? Cash flows. Your cumulative what? Cash flows. Your cumulative cash flows, this year 0 means it is the year when it was the initial investment here. So this 8 million means it is the initial investment. So you don't consider it. So you say 600 plus 1800, is that 2400?
Yeah.
2400 plus 32 50?
6.
600. 5600 plus 3000.
86.
86 plus 35.
121.
Is it 11 or 12?
Yeah, 12,100.
42. Is that 16,100? Is that 16,100?
Yes.
Sawa. Now
Yeah.
the amount you want to recover as your initial outlay is how much? 8,000.
1,000.
And your 8,000 shillings is being recovered here.
Another thing that can be
That is your 8,000 is because it is between year 3 and year 4. So you
Yeah.
say therefore that your payback period will be given by the sum of full years, which is year 3 year. 8,000 is between 56 and 8,000. So you want the full years, which are 3 years. 3 years plus the proportion of the other amount that remains to be recovered. So first, you have recovered 5,600 because it is in year 3. But what balance is remaining if you want to recover 8,000? Let's go 8,000 minus 56. 56. Then you divide that with the cash flows that are expected in the coming period. With the cash flows that are expected in the coming what? Period. And the cash flows that are expected in the coming period is gani? 3,000. 3,000. So how many years are those?
3.8.
How many years again?
3.8.
3.8 what?
Yes.
What was that?
Yeah.
Right, then give me a minute.
Okay.
rights of someone who has been chapter 1 hapo kwa criminal law.
Same. Acceptance rules. Acceptance rules. Acceptance rules. See? See? Number 1, in case of mutually exclusive projects, select projects with the shortest payback period. Select projects with the shortest payback period. Number two. Number two. Number two. For ranking purposes, select the project with the shortest payback period. Select the project with the shortest payback period. Advantages of payback period. Advantages of payback period. Number one, it is simple to use. It is simple to use. Number two, the choice of projects. Choice of projects with the shortest payback period. Choice of projects with the shortest payback period. Improves the liquidity position of the fund. Improves the liquidity position of the fund. Improves the liquidity position of the fund. Disadvantages. Disadvantages. Number one, it ignores the time value of money. It ignores the time value of money. Number two, it ignores the cash flows. It ignores the cash flows accruing. The cash flows accruing after payback period. Number next, it is not consistent. It is not consistent with the wealth maximization objective. Wealth maximization objective. Wealth maximization objective. Since wealth does not depend on payback period. Since wealth does not depend on payback period. The second member, accounting rate of return. Accounting rate of return. accounting rate of return, same. It is also known as a return on investment. It is also known as a return on investment. As a return on investment. It is a ratio which uses accounting information. It is a ratio which uses accounting information as generated by financial statements. As generated by financial statements. Such as the balance sheet. Such as the balance sheet. Such as the balance sheet. We say ARR. ARR will be calculated as follows. Will be calculated as follows. Average profits. Divided by average investment costs. Average profits divided by average investment costs. Divided by average investment costs. Right. Go to December 2021. Question 5A. Question 5A.
ATD.
Yes. ATD.
It is on a pilot paper.
Have you seen it? December 2021, question 5A?
Yeah, pilot paper.
Sorry?
It is a pilot paper.
Yes, a pilot paper.
Yeah.
Five A.
Yes.
Right, read for us.
ABCD Limited is considering a project with the following details. Project X cost 500,000, scrap value of 100,000. The stream of income before depreciation and taxes are as follows. Year 1, you have 100,000, 120,000, 140, 160, and 200. Use a tax rate of 50% and a straight line depreciation. Required, calculate the accounting date of return and the above, and advise the company. Highlight the advantages of using the ARR technique in evaluating projects.
All right. So what you do, so the accounting rate of return is simply the average profits divided by the average investment cost. Such that here, you don't use cash flows, no, you use accounting profits as per what you have recorded in your income statements and your balance sheet. All right. So I think you can start by determining your average profits, but for us to do that, the profits here are before tax. The same, the stream of income before depreciation and taxes are as follows. So let's determine our profits after tax. Profits after tax and depreciation. Remember, your accounting profit normally will be net of tax and also of depreciation. All right. So your depreciation charge here, they say it is on a straight line basis. They say it is on a straight line basis. So it basically means it is your cost minus your salvage value. Divide that by your useful. Divide that with your useful lifetime. This is the depreciation per annum. So the cost of this investment is 500,000 minus the salvage value or the scrap value, 100,000, divided by the number of years this asset is being used, which is how many years? 5 years. So how much is your depreciation per annum? How much is your depreciation per annum?
80,000. 80.
How much?
80,000.
How much again?
80,000.
80,000.
Yeah.
Sawa. Alafu unakuja hapa. Remember you want your what? Earnings or profits after tax and depreciation. So you have your year 1, year 2, year 3, year 12, and year 5. Your earnings before tax and depreciation was how much? This was 100. That was 180. That was 140. That was 160. And that was how much? You less your depreciation. You less your depreciation, which is 80. That is 80. That is 80. That is 80. Then you're going to get your earnings before tax and after what? Depreciation. This is 20. This is 40. This is 60. 20. Then you less your tax, which is at 50%. So that means that is 10. That is 20. Is that 40? That will give you your earnings after tax. 10, 20, 30, 60. Those are your earnings after tax. Earnings after tax. Now that we have our earnings after tax, which is this one, we can determine our average profits. Average profits. We say it is this total profits, which are how much? 10 plus 20 plus 30 plus 40 plus 60 divided by the number of years, which is 5 years. How much is your average profit?
That's true.
That's it too?
Yes, that's true.
That is the average what? Profit. All right. Let's determine the average investment. The average investment, you determine it as your initial investment cost, which is 500,000, plus your salvage value of 100,000 divided by 2. Is that 300? You'll have
Yes.
to go in thousands of shillings.
Yeah.
These are in thousands of shillings. All those are in thousands of shillings. So therefore, your accounting rate of return will be your average profit of that return divided by your average investment of 300. How much is that?
Zero point 11.
0 points?
11.
So as a percentage, it means it is 11%. As a percentage, basically means it is 11 what?
Percent.
So 11% of your investment is being returned by the profit. So listen,
Yes.
those are the non-discounting what techniques.
Yeah.
All right. So have decision rule. Decision rule for ARR. Decision rule say. Decision rule. Number 1. In case of mutually exclusive projects, select projects with the highest accounting rate of return. Select projects with the highest accounting rate of return. Next, for ranking purposes, select projects with the highest ARR, or select or rank projects with the highest IRR first. Rank projects with the highest ARR first. The highest ARR first. Right. Advantages of ARR. Advantages of ARR. One, it is easy to calculate and understand. It is easy to calculate and understand. Number two, the accounting profit is readily available. The accounting profit is readily available. Disadvantages. One, it ignores the concept of time value of money. It ignores the concept of time value of money. Number two, it uses accounting profits instead of cash flows. It uses accounting profits instead of cash flows. Which are affected by accounting conventions. Which are affected by accounting conventions. Right. So after a short break, we will start with discounting techniques. Number one, net present value. Net present value. Net present value. Same. This is a difference between present value cash inflows over the entire life of the project. Present value cash inflows over the entire life of the project, and the present value cash outflows. Present value cash outflows.
There's a price. What is the price? The price is the consideration that is paid for the
Acceptance rule or decision criteria. Acceptance rule or decision criteria. Number one. Accept projects. Accept projects with positive NPV only. With positive NPV. Positive NPV. Number two. Number two.
There is something called an agreement to sell.
Number two. Reject projects with negative NPV. Reject projects with negative NPV. Number three. For ranking purposes, accept projects with highest NPV.
In a step, already given them, should it disappear or lost to get destroyed? But in an agreement to sell,
next, for ranking purposes,
in a step, if I finish the one, you can soon. In an agreement to sell,
accept projects with higher or rank projects according to highest NPV. Rank projects with highest NPV.
in a sense, you are the one who will sell it. In an agreement to sell,
Right.
An example. Yes. Six ways in which ideas and statements can be terminated. You are listening somewhere. You are reading somewhere. How can the list be terminated?
So let's do a question.
Ways in which ideas can be terminated. Or ideas can be terminated by
December 2021.
you will paint
Question 3B. This December 2021 question 3B. Notice it's not the pilot paper, eh? Not the pilot paper.
I am there.
Read for us.
Dynamic Public Limited Company intends to invest in Project Y, which is expected to generate the following cash flows. 400, 20, 30, 40, 50, 30, up to year 5. Additional information: the cost of capital is 12% per annum, and the acceptable discounted payback period for Dynamic Company is 3 years. Required: advise the management of Dynamic Company on whether to invest in Project Y using the following methods: NPV, profitability index, and discounted payback period.
Right. So in this question, they're asking you, advise the management on whether to do what? To invest in that project. So basically, payback period is the difference between the present value cash inflows and present value cash outflows. Present value cash inflows and present value cash outflows. Yeah? such that this method normally considers the time value of money. The time value of what? Money. Remember, or it normally discounts cash flows. It discounts what? Cash flows. So let me show you how you deal with this. So you have here cash flows. One, two, three, 4, 5, 20 down, 30, 40,000, 50,000, and 30,000. So what you do here, guys, is you introduce your discounting factor. Your discounting what? Factor, which is your present value interest factor. Present value interest factor. Your discounting rate is 12%. 12%. So using your tables class, specifically table what? Table
1.
Because these are not annuities.
Yeah.
So as 12%, unachukua 12% year 1, which is how much? 0.8929.
Yeah.
Then you take 20,000 and 0.8929 ngapi?
$17,580.
17,580.
Yeah.
The next one is what?
No, 17,858.
858.
8, yeah.
The next one is 0.8116. Actually, 0.7972.
Yeah.
How much is that? How much?
23,916.
23,916.
Yeah.
The next one. How much?
28,472.
$0.6355.
$31,775.
How much?
17,022.
How much again?
17,022.
17,022?
Yes.
What's the total?
$119,000.
192,000.
119,043. 119,043. No, 043. 43 shillings.
043, yeah.
Yes.
Then invest, this is your present value cash inflows minus your initial investment. How much was your initial investment?
It was is that question?
100,000, yeah?
Yeah.
How much is the NPV?
19. 043.
Hapo tuko sawa?
Yeah.
Discounted payback period. Discounted payback period. Same. Discounted payback period. It considers the number of years, the investment, the number of years, the investment will generate the number of years the investment cash flows. The investment cash flows will recover its initial investment. Will recover its initial investments. Right, so we can use this method. We can use the discounted payback period to value what, or to see whether it is worth to invest such a project. So when you're advising them here, for that, you'll tell them to take the project. The reason you're telling them to take the project is because it is generating positive what? NPV. Because it is generating positive what? NPV. It is generating positive NPV. Yeah? Right. So let me show you the discounted payback period. So what you do, we're still going to use this question. Let's still use this question. Therefore, the cumulative present values. getting the cumulative present values, that is 17,858. We're getting the cumulative present values from this question. The next one you have it. 17 plus 23, 9, 16. 41 and 74.
Yeah, 41, yeah. No, 41, 774.
774. Plus 28 for 72. 1746.
Yeah.
Plus 31. 775. 102. 020. 119. 043. Your 100 million is here. 100 million is there. So you say your payback period will be the sum of full years, which between 70 and 100, the full years are how many years? 3 plus the difference, which is 100 million minus 70 to 46. Divide by the next period cash flows, 31, 175. So 31, 775. How many years are this? How many years are this? How many years?
3.9.
3.9 years.
Yeah.
Upon sound?
Yeah.
Right, I think we can call it a day.
Yeah.
We'll pick it up from there on Saturday.
Okay.
Right.